let us go ahead. Sorry.
Yeah, thank you.
So good afternoon, all the members, entrepreneurs, friends who have joined this session today. I know we have less participation because of the rains, but anyway, we decide to go ahead. So on behalf of CII Southern Gujarat, it gives me immense pleasure to welcome you all to the third session of the CII Virtual IPO Knowledge Series 2026. I extend a warm welcome to our distinguished speakers, industry experts, entrepreneurs, MSMEs, business leaders, finance professionals, and all participants who have joined us today. Over the last two sessions, we have explored the strategic importance of raising capital through an IPO and gained an understanding of the various routes and execution processes involved in accessing capital markets. These discussions have laid a strong foundation for businesses aspiring to embark on their public listing journey. Today's session takes us to the next and perhaps one of the most crucial stages of IPO preparedness, business diagnostics, where understanding the importance of financial and regulatory governance would be covered. As businesses prepare for public markets, success depends not only on growth and profitability, but also on the strength of their governance framework, financial discipline, internal controls, regulatory compliances, and organizational readiness. Identifying these critical gaps well in advance enables companies to build investor confidence, enhance transparency, and ensure a smooth IPO process. Today's discussion will focus on helping businesses understand the financial and regulatory governance framework expected from listed companies and the key areas that promoters should evaluate before initiating their IPO journey. We are delighted to once again have our esteemed knowledge partners from Span Consultech with us. It gives me pleasure to warmly welcome Sujata Ben Desai, Director and Chief Operating Officer of Span Divergent Limited and Span Consultech, and Parasbhai Desai, Director and CFO of Span Divergent Limited and Span Consultech. Their extensive experience in IPO advisory, corporate finance, governance, and capital markets continue to provide invaluable guidance to businesses preparing for sustainable growth through public markets. We sincerely thank both our speakers for their continued association with CII Southern Gujarat and for sharing their practical insights with our members. I encourage our participants to actively engage during today's session and take full advantage of this opportunity to interact with our experts. With these words, I once again extend a warm welcome to everyone. And it is now my privilege to invite Sujata Ben to commence today's session and share her valuable perspectives on business diagnostics and IPO readiness. Yes, Sujata Ben.
Thank you, Nirav bhai. Yeah. So good afternoon, everyone, and welcome back to the IPO Knowledge Series in partnership with CII. I'm Sujata, CEO and Director at Span Consultech. This is advisory venture of Span Divergent Limited, formerly Span Diagnostics Limited, which is one of the early companies of Surat listed on stock exchange. Span Consultech help promoter-led businesses realize their full worth. We provide services on business diagnostics, strategic consulting, IPO advisory, turnaround advisory, and CXO services. Today is episode 3, and if you have been with us for the journey so far, you already know the arc we have been building. In episode 1, we asked why IPO. We explored the transformation a listing brings, capital, credibility, and a legacy that outlives the founder. In episode 2, we asked which route. We unpacked SME versus main board, various routes like financial or QIB, fresh issues versus offer for sale. We also discussed the nuances of the pre-IPO placement. So by now, many of you in this room have a fairly clear answer to why you want to list and which route fits your company. Today, we ask a very different and frankly speaking, it's a much more personal question. Is your company actually ready? Wanting to IPO and being ready to IPO are two completely different states of being. A company can have brilliant revenue, strong margins, compelling growth story, still not be ready to face a public market, public shareholders, and public scrutiny. Why? Because an IPO does not just look at your P&L. It looks at everything. your governance structure, your internal controls, your related party transactions, your HR policies, your IT systems, your customer concentration, your legal compliances going back years. This is exactly where business diagnostics comes in. Think of the same in this way. Before a company goes in a full medical checkup, a good doctor does not just check your pulse. They check your heart, your lungs, your blood work, your history, everything that could either support you or quietly sabotage you on the big day. A business diagnostic is precisely that, a 360-degree health checkup for your organization, conducted before the regulators, the merchant bankers, and the public markets do it for you, often in far less forgiving ways. And here is the part that should energize every founder in this room. A diagnostic does not just expose your weaknesses, it reveals your strengths that you may not be even showcasing well enough. So it is as much about positioning your story correctly as it is about fixing the gaps. As we begin today, I want to leave you with this thought. Your IPO will be judged not only on your numbers, but on how well your organization can withstand a magnifying glass. Let us get into exactly how it is done. Mr. Paras Desai, CFO and Director at Span Consultech, will take us deeper into this conversation. Thank you.
Good afternoon, everybody, and thank you for joining amidst such a heavy rain and taking your time to attend this webinar. Let me just share my presentation. Is it visible to everybody? Okay.
Yes, sir.
So let's start this third episode. But before that, once again, like last two episodes, let me share with you a small experience which I had few years back. I was going to an important meeting and I was fully ready. Formal shirt, a new purchase blazer, polished shoes, and with a good confidence. Just before entering the meeting room, one gentleman looked at me and smiled. I thought he was greeting me. I even thought that he might have appreciated my blazer. But that person quietly came to me and said, "Sir, the price tag is still hanging from your blazer." I was just taken aback. In the meeting, nothing major has gone wrong. The blazer was good. The meeting was good. The person was also good. Only one small tag was visible and it was left behind. But at that very moment, I realized something very important, and that is we may feel ready, but the readiness is tested differently when someone else look at your readiness closely. Now, in the context of this today's episode, how relevant this experience could be. That day, that gentleman found only one tag. But in our IPO journey, when auditors, lawyers, merchant bankers, stock exchanges, SEBI, investors looking closely to your company, they may find many such tags. Slow closing of books, informal controls, incomplete documents, related party transaction, unclear margins, or governance gaps. So a business diagnostic is not meant to criticize the company, as Sujata just said, it is also to unearth the strength. But it is more importantly meant to quietly find those tags before the company enters the public domain. It is very important that before somebody else finds out, it is we internally who finds out those flags or those tags before we go to the public. So episode 1 was about IPO. Episode 2 was about route and execution. Today, episode 3 about business diagnostics, the honest check that helps company move from we feel ready to finding and removing those tags to we can prove to the market that we are ready. So today episode is not about selling fear at all. It is about reducing surprise. A company may be profitable and respected in its market, but public market readiness quite requires evidence. Today we will discuss the work that turns private confidence into the public market confidence. So let's first place this episode into the larger IPO journey. So why diagnostics comes before regulatory filing or even merchant banker comes into the room? A promoter normally begins with the confidence. The business is running, customers are buying, banks are lending, and profits are visible. From inside, it feels natural to say we are ready. But capital market applies different lens. The company is no longer judged by the owner's confidence. It is judged by the evidence. The evidence is the most important aspects when you undertake an IPO journey. A business diagnostics gives management a private control opportunity to see what investors, auditors, and regulators may later question. The key is timing. Gaps found early are manageable. Gaps found late becomes deal risk. So the basic premises of business diagnostic is that we found ourselves what are the gaps, what are the tags before somebody else tells us that this is what it is the gap. So before we go deep, let us see how wide and focused the diagnostic range really is. A common misconception always we come across is to think that IPO readiness is only a finance department exercise. In reality, investor price the whole company, not only the balance sheet. They put entire company, entire working, each and every aspect of the company under the lens. Revenue quality, the pricing power, the product strength, capacity, quality, supply chain, working capital, you name any process, any aspect of the company, they comes under the lens. For example, a company may have strong margin, but in those margins depends on one unaccounted related party transaction. A company may have a good revenue growth, but if receivables are stretching and cash is not coming into the company, probably that growth is will not be seen nicely by the investor. The key message in this aspect is a business diagnostic should look at the business the way investor will look at it, using evidence rather than just confidence. So to make this practical, let us imagine how a typical business look when we plot these various functions and various feature of the business under the lens. So this chart on the screen represents how a business diagnosis assess a company before IPO preparation on different parameters. Those parameters could be different or vary slightly from business to business, but this is the kind of radar which business comes under. The most companies are not weak under the board. In fact, they usually have genuine strength. A promoter may have built a strong product, a loyal customer base, a capable plant, or a good market reputation. The strengths are real and should be protected. As Sujata Ben said, the business diagnostic is also finding strength, not only the weakness. But IPO readiness is often decided by the dents in the profile. It's good if it is fully swelled, but if there is a dent in the radar, then we need to be a little bit careful about that. These dents may be in cash conversion, that is long outstanding, systems, reporting, late reporting, no timely reporting, controls, no financial controls, we are weak in the financial controls, or the governance. These are, and more importantly, and more dangerously, these dents, they are not visible in day-to-day business because before the public life, in the private company, often it runs on relationship, memory, and informal discipline. So such dents are not visible or not felt, but the public market is different. It needs repeatable system and reliable evidence. It works on evidence. It will not work on feeling or intuition or confidence. Public market requires constant evidence. Investors do not only ask whether the business works, they ask whether the business can be understood, measured, monitored after listing for consistent performance one quarter after another quarter. So this chart is meant to help the company identify where real readiness works lies. We can identify the gap. The toilet spikes create the equity story, but the debates then often decides valuation discount, and that is what we need to be very careful and address it beforehand. So when we talk about businesses, many of the businesses are in manufacturing. So let's look at the manufacturing capability, keeping manufacturing capability in central, and pose for how manufacturing strength is tested. For a manufacturing company, may it be chemical or pharmaceutical or biotech or engineering company, the diagnostic cannot stop just at accounting numbers. Manufacturing strength has to be proven through operating evidence, the evidence which are reflected in its operation quality or operation capability. A company may say, we have capacity. The diagnostics ask, what is installed capacity? What is available capacity? And what is actual production after downtime, changeover, and bottlenecks? That means, what is the utilized capacity? A company may say, we have cost advantage. It's a very simple, plain sentence. But what we must look, or what the business diagnostics checks, is that what is your raw material yield? What is your energy consumption per unit of product? What is your labor productivity? What are your logistic costs? What are the wastage against history, your trend, and against your industry peers? Quality is also important. Same way, maintenance and uptime of the plant. So the manufacturing question is not only, is the company profitable? The real questions the diagnostic try to unearth is, can the claim advantage be repeated, documented, and scaled up after an IPO? So the investor do not look your current position or your recent results. They try to see or ascertain that your performance is repeatable, is sustainable, or it can be capable of being scaled up once IPO money comes into the business. So once this operation proof is established, let's move to the core IPO readiness, which we break down into 5 distinct pillars. So let's go one by one. So from here, the discussion moves from the broad diagnostic to the deeper readiness built for the company, which is built on 5 pillars. The first part is financial reporting. This is where books are rebuilt under Ind AS. Ind AS is nothing but Indian accounting standards, which has come into effect from 2014 or 15, and which is based on international accounting standards. Another is segment reporting is prepared. The closing process is made fast enough for the listing company. So this is the first pillar. The second pillar is internal financial control. Here, the company has to move from informal approvals and personal supervision to a documented, tested, and certifiable control framework. The third pillar will be the quality of profit. Investors do not only ask whether profit exists, they also see whether it is sustainable, transparent, and most importantly, backed by cash. It is not just the book profit, the profit is getting converted into the cash. The fourth part is structure and governance. These include your group structure, your subsidiary companies, your related party transaction, the composition of your board, which is one of the most important governance structure, its committee within the board, and the policy. And the fifth part is investment case. What I mean by investment case is this is where the investor find that whether this company is worth investing in or not. This is where management depth, equity story, tax structure, ESG readiness comes together. So these 5 areas are connected, interconnected. They are not isolated. The financial reporting gives numbers. The control makes these numbers reliable. Profit quality makes them believable. Governance gives trust to all the numbers. And the investment case converts all this into a story investor can believe. So let's now begin focus individually on each of the pillar and start with the first pillar, financial reporting, because the numbers that go into the prospectus must be revealed for public market use. So you have been hearing the restated financial statement. So what do we mean by restated financial statement? So it is a transition to Ind AS accounting standard. Ind AS conversion is one of the first serious tests, the IPO readiness. Many private companies prepare financial under Indian GAAP, that is generally acceptable accounting practice, and are comfortable with these numbers, and this is fine. But the listed company reporting is under accounting standard. So for an IPO, historical financial, not only that post IPO you have to prepare your financial into Ind AS standard, it also requires that all your historical financial statement also have to be restated. That means converted into the Ind AS accounting standard, and that restatement is not mainly a format change. It is not like simply reorganizing the figures. It involves judgment, revenue recognition may change, lease accounting may change, the reporting of financial assets change as compared to what you have been doing it. Financial instrument need fair valuation, and group entities may need consolidation, removing intercompany transaction. So adaptation of Ind AS must begin early, ideally around 18 months before the filing, because the restated financial number become numbers shown to investors. Another reason is once you restate your financials into Ind AS format, it might change your financials parameters. Your profit might change, your net worth might change, the way you report certain items in your balance sheet might change. So in all, Ind AS readiness is therefore not only accounting compliance, it is the foundation, the basic foundation, the first step that you need before you start your IPO journey. Understand why this process takes 18 months, or why everybody says that we must start transition to Ind AS 18 months back. Let's look what physically changes when you in your balance sheet when you transit to Ind AS accounting standard. As I mentioned, restatement from GAAP to Ind AS can materially, substantially change the way company is presented. Revenue recognition is the first area. Under Ind AS 115, that is an accounting standard for the revenue recognition, the timing of revenue depends on the performance obligation. For example, you are having you are in the real estate of the project business, and you have received certain payment in advance. So total project cost is 50 crore, and then you have received 10 crore rupees as advance. Still, under Ind AS, under circumstances, you cannot book this as a revenue. It may be reported in your balance sheet or as an unaccounted or unrecognized revenue. The reason being, in such situation, there are two standards for revenue recognition, either which is based on the completion of the project basis or the proportionate of the cost basis. So you can book as a revenue once the project is finished, or you can book the revenue in proportionate to the cost that you have incurred. So this is just one example how the revenue recognition get changed as compared to what you have been doing in GAAP. If there are long-term contracts, bundle obligations, warranties, the revenue get changed. Lease is another important area. So far, any lease, operational lease, you may be showing it as an expense, lease expense. Under Ind AS, this gets converted into asset as one part and liability on another part. The asset is right to use, liability is future liability to pay lease. So this also change when these accounting entries change. You change your EBITDA gets changed, your debt obligation changes, so it creates a different picture. Similarly, financial instrument also move from cost-based accounting to the fair valuation. If you are invested in a share or mutual fund with your surplus money in your company, earlier you must have been reporting as a investment value or the cost value, historical cost value. Under Ind AS, it has to be reported as a fair value. If there is an increase in the current price, it may be reported as unrealized gain or goes directly to the other comprehensive income into the reserve. So these are the different parameters which gets changed. The flow of those accounting entries gets changed when you transition to the Ind AS accounting standard from your GAAP. So this cannot be done overnight. This cannot be done just in one quarter. You have to do lots of housekeeping. You have to probably make your chart of accounts proper, and you have to restate, change see the effect of restatement, and then move it forward. So once the accounting standard base is correct, the next challenge is speed. How quickly can company close and report? We have transitioned from accounting standard from GAAP to Ind AS, but that is just the beginning. This reporting has to be generated quickly within a prescribed time, quarter after quarter. So what are those timelines? Let's look at that. The most important thing that all of us must remember is a listed company lives on a quarterly reporting clock. Every quarter, something has to be reported, and most importantly among them is your financial results under Ind AS format. Let's look at a private versus public reality. Private companies generally take 60 days to 75 days, even sometimes more, for an annual close. Once you become listed entity, you must publish quarterly result within 30 to 45 days from the close of the quarter without fail. And if you fail, there are consequences. The issue is really about accounting team not working harder, how hard they work. But if the slow close is also result, if reflects deeper problems like late reconciliation, manual spreadsheets, scattered data, inconsistent chart of account, delayed inventory valuation, unresolved intercompany balances, or weak cutoff procedures. All these aspects, if you don't bring in discipline, and if you try to carry on the previous practices, this will result into a delay in preparing or closing your accounts. The fast close process has to be designed, thought out. The company needs standard processes, SOPs, automated reconciliation, clear responsibility among the staff. Who is responsible for what process? And that process has to be completed within what time? Monthly discipline, ERP implementation, and one has to practice quarterly close filing. You need to execute at least minimum 2 practice quarterly close before even you file for DRHP or the IPO. This is important, very, very important, because The first quarter after listing is not right time to discover that company cannot close in time. If it happens, it has a very, very bad repercussion. Missing the reporting rhythm immediately after listing damage credibility, catch regulator attention, and it gives very, very, very bad messages to the investor. So this is very important. Timely reporting is one requirement, meaningful reporting is another. So that brings us to the segment reporting and story in the numbers. So we transition to Ind AS, we are reporting it in time. The another dimension to that is the meaningful reporting. Let's see what it is. In public life, the investor do not read financial statement just for compliance to see that, okay, quarter end within 30 days or within 40 days, financials have come, the company is compliant. No. They read them to understand the total landscape of your business. What is happening in your business? They do it with the microscope. The segment reporting is one aspect which they look for. It is important because a company may have different product lines, different geographies, a business with different margins or the capital requirements. So a business might be operating differently with the different parameters. An investor wants to know which part of the business is growing, which part is more profitable, and where in which segment of the business more capital is being deployed. And the number must match, they must reconcile. Revenue growth should connect with margin movement. The margin should connect with capacity and cost. The ROCE, return on capital employed, should connect with the capital employed. Working capital days should connect with the cash conversion cycle. Free cash flow should support the profit story. So there, with this segment reporting and investor giving so much of importance to this segment reporting, the management discussion and analysis become the focus point. The investor always look forward what management thinks about the business that they are handling. Management must explain anomalies, the plans for each segment, the risk involved, outlooks, and strategy honestly for each segment to maintain or to contain investors' confidence. The larger point is this: investors do not only buy numbers, they interpret numbers. The diagnostic must check whether the company's number tells the credible and consistent story. So that is most important, and the importance of segment reporting. So now we move from the numbers themselves to the control framework that allows management to certify those numbers, the credibility of those numbers. And that comes to the discussion on the second pillar. What we are discussing about, one of the most important aspects is internal financial control. It serves as the bridge that connects your business risk, your control design to address those risks, your operating system, and evidence that each control works, and your executive certification of such controls. So overall, if you look at internal financial control system in a company which needs to be implemented before one goes public, it has three objectives. One, it must safeguard your assets, which means fixed asset, cash, inventory. The second objective is it must prevent fraud. And the third objective, it must ensure reporting accuracy. The number that is going to the investor are accurate. This spans, this entire system, internal financial control, spreads from establishing an ethical tone at the top, at the board level, to monitoring how data flows through your servers or IT infrastructure. Now, how does this entire flow happens? The life cycle of IFC is first, you identify the risk, then you design the control to address those risks and test those design. Then you implement those design and prove that it is operating effectively. If it does not operate effectively, you identify the gaps and immediately do remedial action. And once everything is fine, certify that. So this is how the internal financial control gets established into an organization. The golden rule of IPO readiness applies here. If a control isn't documented and successfully tested, it does not exist. So IFC is not just for the sake of putting it on paper. It must demonstrate its performance. It must be tested. It must be certified. So with this bird's eye view of IFC, let's now see what IFC certification actually demands. Let's go a little deeper into the IFC framework. So this slide, if you go read this slide, it will explain you why IFC become a serious matter in IPO preparation. Under the Companies Act and SEBI regulation, the CEO and CFO must personally certify that internal financial control are effective. And anybody who certifies under the law, it carries an importance of undeniable, unexplainable weight. The controls have to cover important processes like revenue, procurement, payroll, treasury, fixed asset, inventory, IT system reporting. So all the process which carries risk of fraud or any leakage of financial assets, those all comes under the control, and each and every process have to be monitored. For example, in procurement, the system has to be defined and documented. Who can create a vendor? Who can approve a purchase order? Who can accept goods? Who can approve invoice? And who can release payment? So it's an end-to-end cycle from procurement placing orders to release of the payment. If 1 or 2 persons are only handling entire process, then the risk is obvious. So because I am only I am only checking, if something goes wrong, nobody is there to identify. So this is how internal control system needs to be designed and established. If the controls are ad hoc, investors worry about leakage, fraud, misstatement, and management override. Strong IFC protects both the business and valuation. So this brings us to a question. If controls are not there or informal, how to build them? What could be the process? So let's see that process into the next slide. So if your business or any company is running on informal controls, the shift to listed company discipline takes time. It cannot be just overnight. So the first step is to map each material process from beginning to end. Material process means the critical process which may be susceptible to the risk or the financial leakage. Once again, to give you an example, take revenue as an example. It starts from order receipt, the price check, whether the order has been received at the approved price, credit approval, dispatch, invoicing, revenue recognition, collection, reconciliation. At each step, ask the question, what can go wrong at this stage? Find the reply, find the possibility. Then, second step would be, once the risk is identified, then the control should be designed for addressing that risk. If there is a credit risk, there should be a credit approval. So if party's outstanding is 10 lakhs and his order value goes the outstanding to 15 lakhs, it should not get executed automatically. There has to be a senior person who must approve after taking the stock of the situation. If there is a dispatch risk, there should be a matching of order, delivery challan, and invoice. All the quantities should match, the price should match, so that there should not be any risk. If there is a payment risk, there should be a maker-checker approval. I make the payment, the approval goes to somebody else. So these are the risk area in each and every process in the business has to be identified, risk identified, and the control has to be put in place. The third thing is this control has to be documented and tested. Just knowing control is not sufficient. There has to be documented and has to be tested to see that those control really works. The auditor will not rely on control simply because you have a nice SOP. They ask for evidence to check that control really ran. Typically, an auditor will demand, give me a complete cycle of a particular order. He randomly will demand, or a procurement order, and then he will check at each and every stage, comparing with your control document or SOP, whether the proper control mechanism has been employed or implemented or not. So in IFC, the summary is identify risks, design system, document it, run it, and give evidence to prove that it works. So these strong controls directly protect the next crucial element of IPO readiness, the third pillar, and that is the true quality of your profit. So let's transition to this third pillar. The profit is important and everybody feel comfortable if there is a profit in the company. But investors do not just stop at profit. They ask a deeper question. What is the quality of that profit? And what do we mean by quality of profit? Somebody may think profit is profit. What is about that? Let's see how investors dissect the profit. A company may report profit, but the market wants to know whether the revenue is recognized correctly as per the Ind AS standard. Whether the margin are sustainable, the profit is today, it is a one-time profit, it is a repeatable, sustainable profit. And whether profit is converting into operating cash flow. You see, we have seen many P&L showing a huge profit, 6%, 10% PAT, EBITDA 24%, 30%. But if you look at the cash conversion cycle, it is not, the cash against that profit is not coming to the company. It remains in the market. It remains in form of account receivable. So that profit quality is not good. So the profit is increasing, but receivables are also increasing. Investors become cautious. The market also examines whether transactions are at arm's length. If you are doing transaction with your sister concern, your related party, or within the group company, and then you book profit into your books of account, investor will not be convinced. They will have a closer look. Exceptional gains may improve heading profit. A one-time profit, a sale of asset which have brought you a profit, it sits in your books of account, but that is a one-time exceptional item. It does not reflect your operating profit. So that also comes under the scanner. So business diagnostic approach must be to find the answer to the questions investor asks for each rupee you report. So this is what we mean by what is quality of profit. Now let us understand what happens when a company has a real profit but lacks necessary visibility to defend during due diligence. So let's further dissect the profit into our next slide. Many private businesses like yours are genuinely profitable, but their way of working may be informal. One could be related party revenue. Another could be one-time gain. Third, is a cash-heavy transaction which create under the public lens a different problem. The company is profitable but not being reported because of the cash-heavy transaction. In spite of your healthy business, probably you will not be seen look positively by the investor. Group entities also requires attention. If revenue, cost, employees or assets are shared across multiple entities, and when you consolidate your business, your intercompany transaction get knocked off, and your standalone cost might increase or revenue might decrease. So public market wants one clear economic picture. The margin movement in IPO year needs special care. It may be genuine. If it is genuine that if your margin or profit has increased in the same year where you are planning for an IPO or your listing, if it is genuine, you must create evidence. You must prove it is genuine. If it is temporary, don't try to project it and try to build value upon that one-time margin. So the SIP required here is very clear. What is accepted privately must become documented and justified and become defensible so that the company can present this publicly with equal confidence. So this is what we mean by the quality of profit. Now the profit visibility is closely connected with the structure and governance. Without proper structure and governance, the profit is under lens. So let's talk about the fourth pillar, the structure and governance, and how it pans out. SEBI does qualitative review when you file for an IPO. And it focuses, other than your financials, heavily on the complex corporate structure. It prefers simple structure, which is easier to understand, but a complex structure with many subsidiaries, cross-holdings, all entities, and unclear commercial rationale create doubts. If your two subsidiaries are involved into the same business, into the same segment, probably SEBI will not look at nicely. If a transaction with related party or sister concern cannot be defended or explained, or they are not at arm's length supported by documentation, it is reviewed critically. So this factor should be addressed beforehand and it should be identified into the business diagnostics. Waiting till due diligence is dangerous because then the company is explaining all these things under pressure. This work should ideally begin 12 to 18 months before filing because restructuring, tax implication, contracts, all this takes time. So the objective is to present one clean and defensible listed entity. The cleaner the structure, the better for SEBI as well as investor. A clean corporate structure must be overseen by a genuine functioning board of directors. Another important aspect of a good governance, good corporate governance, and an IPO bound company or the public listed company is a very, very strong board of directors. So let's look at that. So it is the most radical shift during IPO preparation. By law, with the regulation, it requires at least 1/3 independent directors, not necessarily the family members or your existing shareholders. The directors should not be connected with your business in any way, not even at the shareholder in your company. So 1/3 of your board must be independent director or half if chairman of the board is a promoter himself. It must have at least one woman director. So such constitution of board should genuinely be functioning. It should not just remain on the paper. Company needs director who genuinely understand the complexity of the business, not necessarily your business, but there are common processes of the business. There are financial disciplines, there are technical expertise. So those directors' name should bring credibility to your company and bring some experience, some expertise, some knowledge, which your business can leverage. So that is what is being seen by the outside world. It is also necessary to establish functioning committee. The most important among them is audit committee, nomination and remuneration committee, stakeholder committee, relationship committee. Those committees are operate strictly under activity assigned to them, the policy framework. So the good governance is not about reducing promoter control. We are not saying that the promoter control should reduce. It is about moving from personally led decision to institutional led oversight. What we mean by institutional led oversight is the board which also participate in important decision and approve important decision proposed by the promoters. They need to be convinced. So let's see, after knowing importance of the board, let's see how this board maturity evolves over the course of IPO readiness journey. So let's evolve there. If you look at governance maturity ladder, which is available here in your slide, most family or closely held business start at level 2 or 3. Means they are either informally managed or process driven, but still insular. Insular in the sense the decisions are confined to promoters of the closer group. Reaching level 4, which is a main board ready, requires 12 to 24 months of deliberate, unskippable work. We have been discussing even in last episode also, we have discussed what 12 to 24 months preparedness amounts to. So level 4 means the board acts as a true objective oversight body with active independent directors debating management ideas through live committees. As I mentioned, the board asks questions. If you have an investment proposal, they need to be told or presented that this is going to be my ROC or the return on investment. The business diversification ideas are debated in the board. They give their inputs. So it's a very formal but enriching interaction or the decision making for the matter of strategical importance. Company may place itself honestly on this ladder today to assess this current position and chart the steps forward, depending upon whether you are at pillar 1, stage 2, stage 3, you must assess honestly, do introspection, and then depending upon the position, you must define your way forward, how to move to the at least stage 4. So business diagnostics task is to not judge or address you emotionally. It places the company honestly, then chart the sorted credible. It's very unforgiving, very forthright business diagnostics process. Whether promoter feels good or bad, it's one part, but it will honestly tell what you require to do in order to reach to the stage 4. So governance is one part of investor confidence. Another is equally important, and that is management depth beyond the promoters. So an important section of 4th pillar, let's see. Investor back robust and resilience organization, not only visionary founders. They look beyond the founders. Many successful companies are built around exceptional founder. That is the strength, of course, but it creates key person risk. If the business depends too much on 1 or 2 people, investor apply a discount because continuity become uncertain. A credible second line is therefore very, very important when you are planning to go public, and that comes the human resources. The CFO must own the numbers and be able to speak confidently to auditors, bankers, and investors. Sales, operation, finance, HR, compliances, and technology should have responsible leaders, presentable leaders who knows their function well, deep enough, and who can run their areas without waiting for day-to-day direction from the promoters. This is the kind of strength and delegation that is envisaged by the investor. Family members in management are not negative aspect. No, let us not confuse this, that only professionals are required, family members are looked upon negatively. No, family members are also important if their roles are clearly defined, their compensation is visible, the competition is demonstrated. And so this issue is whether the organization and depth and accountability, and it is in the safe hand. This is more than sufficient. So investor ask a simple question: if the founder steps away for a quarter, does the business continue to run? This proves, or this states, the vulnerability or the dependence of a business on a single key person. So when management depth, reporting, controls, and governance comes together, they support the equity story. We all talk about equity story. We discuss about equity story. So all this together, what we have discussed, build together equity story. So this slides connects diagnostics findings with the valuation, and also justifies the reason why we put much emphasis on the business diagnosis. All boils down to the equity story and valuation. If we have to demystify valuation, it can be demystified by this equation. It says valuation is sustainable earnings into justifiable multiples minus risk discount. Let's break each one. Sustainable earnings comes from revenue quality, margin stability, cash conversion, capacity economics. We all discussed in previous slide the quality of profit, the margin sustainability, repeatability, capacity utilization, manufacturing strength. Multiple comes from the future story, the market opportunity, the right to win, operating leverage, your cost advantage, the use of IPO proceeds, which we discussed in the previous episodes. Investors pay premium for only when they believe the company can grow faster, earn better returns, or build a stronger position to peers. So if we can justify all this strength, they put higher multiple. And then comes the risk discount. Where does the risk comes from? The governance gap, the weak control, the customer concentration, the litigation, regulatory concern, supplier dependence. These are all risk parameters. The more such risks are pursued, the investor tend to discount your valuation. So equity story creates the value by arranging evidence, all these three evidence. The diagnostic identifies the evidence needed to show the equity story, converts it into price investors are ready to pay. So the basic purpose of diagnostics is summarized into this equity story, this evidence which investor looks to have the overall 360-degree view of your company, your business. So after having understood the connection between equity story and the diagnostics, let's look further, break equity story into its main building block. The premium equity story connects four critical elements which demonstrate evidence as we discussed. The first evidence is market opportunity, that is, it offers ample opportunity to generate revenue sustainably. The second evidence is business what demonstrate is proven competitive modes. whether that is intellectual property, distribution networks, or any USP that our business has, can demonstrate and can show edge over our competitors. The third is the financial track record. What you claim should be backed by your past figures or the financial track record. And the fourth is clear, measurable roadmap for exactly how an IPO proceed will create value, how you are going to deploy your fund. So these are the four blocks that you must build based on your diagnostic finding, the equation, and this four pillar putting together, you can build your perfect equity story. So after having understood this equity story concept, let's move beyond the core investment case. Another important area institutional investor look are two very, very important and many times overlooked area, and that is tax discipline and ESG readiness. Everybody know tax is a sensitive area. So as investors, any open tax positions should be resolved or explained. There are litigation going on for long, there are appeals, but there has to be a very clear logic, clear justification, clear explanation for all these open tax position. It should not happen that it is discovered during due diligence as a surprise. It should have been identified beforehand, summarized, documented, and explained beforehand before the questions are asked to us in the due diligence process. Same way, if you have a many intercompany transaction, the transfer pricing mechanisms must be in place, because all in all, SEBI or investor, they look intercompany transaction or related party transactions very closely under microscope. And you should have a proper corporate structure to have this transparency. Similarly, the business must be ready, get ready for ESG, or should be appearing or in a preparation to be ready for ESG. Now, all we know, the ESG is environmental, social, and governance reporting. Environmental tells whether the company uses resources responsibility, may it be energy, water, waste management, pollution, carbon footprints. Social aspect tells whether the company treats people and stakeholder responsibly, people, safety, concerns, etc. The governance tells whether the companies control and supervise responsibly, with trust, transparency, controls, and oversight. Outcome of three factor touches your equity story and valuation. So probably it may not be applicable to you, but the business responsibility and sustainability reporting is the mechanism, core metrics identified by SEBI for top 1,000 public company by market capitalization, where they have to report their ESG compliances in a particular fashion. But that doesn't mean that we do not fall into that category. Your preparedness, your readiness, your future-proofness with respect to this ESG touches your valuation or equity story. So let's now pull our all discussion together, whatever we have discussed so far, and look at the gaps that most often delay the listing if they are not addressed properly. So the gaps could be weak MIS, undocumented related party transaction, open litigation and compliance issue, limited management depth, single person reliance, or no tested internal financial control. These are the generally found gaps that is identified during IPO journey. These delays are painful. It needs lots of homework, lots of work, time, people, attention. But they can be addressed. However, apart from these gaps, there are certain red flags which must be addressed properly. If not, they will derail the entire IPO journey altogether. So what are those? The first among them is complex capital structure. What do we mean by complex capital structure? We also brushed upon that in our previous episode. Is multiple share classes or heavy pre-IPO dilution or other investors with different rights structure. So those must be clean. There should not be any gray, or the capital structure should be as transparent and simple as possible. Second is the material fraud and regulatory litigation must be settled or fully provisions before filing, either as a contingency liability or must be provision, or there has to be a note or explanatory note into your filing. Aggressive transaction via related party purchase or the concessional loans. So these are sometimes identified to jack up the profit or some other purpose. So those must be very clean. So, and the premature revenue recognition or the frequent accounting policy change, those are big no if you are going for IPO. So the remedy is to bring this issue privately during diagnosis process, resolve them as early as possible. Fixing them under public scrutiny is slower, costly, and more damaging. So proactively, we must identify all these red flags, address them before it comes to the public scrutiny. So to manage all this effectively and mitigate this risk, we must have realistic and phased timeline. It should be taken as a project. So phase 1, which takes 0 to 6 months, is the foundation. Run the diagnostic, begin heavy lifting of in-days restatement, clean up group structure and related party transaction. Once the foundation is laid, move to the phase 2, appoint independent directors, construct the reputable board of directors, establish and test IFC, implement your ERP if it is not there, and access MIS close. Run the quarterly reporting successfully. Phase 3, a pre-IPO execution, finalize the equity story, conduct, keep on continuing quarterly closes, and lock in BRSR. Even if it is not applicable, try to develop your system and documentation collection and information collection for BRSR, that is Business Responsibility and Sustainability Reporting under ESG. Without accountable ownership and strict deadlines, the diagnostic remains just on the piece of paper. So execution is very important. So while concluding this episode, let me leave you with an absolute bottom line of the business diagnosis, what it means. IPO readiness is built over months. It cannot be declared in a quarter because it is felt the market is good. No, it's a huge task. A diagnostic turns belief into evidence. Evidence is the most important element in entire IPO journey. It shows what is strong. It shows what is weak, what must be fixed first, and what needs time, so that we can schedule, we can start accordingly. It also protects the promoters from discovering serious issue too late in the process. A good IPO is not just about reaching the market, but it means reaching the market with evidence and credibility. So the final thought is, a diagnostic is not a criticism of the business. It is the preparation that helps good business become a public market ready business. So this is what, in the nutshell of the summary, we tried to convey how important the business diagnostic is, how critical it is to be ready, which break so many myths, so many concepts that a good financial statement or the profitable company is generally ready for the IPO. No, that is not the case. There are so many things under the surface which we need to address in order to become a credible, sustainable uh, uh, IPO company, bound company. So thank you very much. In the next episode, we will move from business readiness to the regulatory framework next week. And in the meanwhile, if you have any questions, we'll be happy to address them. Thank you very much.
Thank you, Paras sir, for your insightful and highly informative presentation, sir. So, for participation, have any question, please ask the speaker, sir. Paras sir, I am audible, no?
Yes, you are audible.
So, anyone have any question?
If anybody has any questions even later on, they can always drop us a
Hi,
mail.
hi,
Or
this is Hemant. Hello.
Yes, please.
Hi, this is Hemant. I am a founder of Invent Honors and Zentric. We are a cybersecurity firm, and we are planning to get into this mode in near future. So
Right.
one thing what I heard about the having a good directors. So we all have, a good education background like a IIM Ahmedabad or a PhD in cybersecurity. But one thing I heard about is the woman director. So is it like really mandatory to have a woman director or not
Yeah,
to have a good IPO value?
Yeah, it is mandatory to have a woman director on the board. And not only any woman director, the woman director who has got qualified to be as an independent director. There are some qualification criteria. So when you induct a woman director, also you need to check whether she is qualified to become an independent director. Of course, if she is not qualified, there is a timeline within which, after coming on board, she needs to get qualified for an independent director. So
Why it is mandatory? Just to know.
Gender diversity.
It's a gender diversity.
Okay, because we are three founders and directors. We all are male. So I don't know. Is it
So
mandatory or not?
yeah, it is mandatory. It is for the gender diversity to give proper
Okay.
presentation to the woman into the important decision making. And there are good women directors, qualified women directors there. One can always look for that.
Okay.
And it is a good idea to have an independent person. It brings a new perspective.
So only independent director is required, not the full-time director. That's what I can
Independent.
understand
Yeah.
here. Okay, fine. Thank you so much, sir.
Pleasure.
We can close the session.
If any questions, we'll be happy to take. If somebody would like to have any questions at the later on, please drop us a mail or inform Vimles ji or Milan ji, and then we will be happy to address them.
I think not any questions, sir. Thank you. Thank you, Paras sir, Sujata ma'am, for your valuable time, ma'am. I think Vice Chairman here some other important work, so he left.
Okay.
Okay, thank you.
So,
Thank you for your
thank you.
presentation,
So
sir.
we conclude this session.
Yes, sir. Please, sir.
Thank you. Thank you, everybody. Have a nice evening.
Thank you, participate to join, and other all detail we will provide through email. We will share
Thank
also
you.
our speakers' communication detail also. Thank you. Thank you for joining, sir.
Thank you.